Universal life insurance. What is it? How does it work? And who really should have it? Today we're going to answer some of those questions for you. We're Shannon and Michael, and we are with Healthcare Genius. So, Michael, I know that you have been in the life insurance business for a long time, so I'm going to ask you a few questions here. Can you just first of all give us a quick overview of what is universal life insurance?
Universal life kind of took off in the late 70s, early 80s when interest rates were so high. Insurance companies needed a way to compete with other investment vehicles or never products, retirement products. And so they came out with this idea that they would pay you an interest rate on your policy that was close to what was going on with bank savings accounts and other vehicles in the market. Whole life had been the traditional product prior to that, but most whole life policies only had a guarantee rate that was probably 3, 4, 5%, somewhere in that range. So it wasn't as competitive. So they came out with universal life, and when it first came out, you had policies that were earning 15, 16%. So it was a way for people to build cash value inside of their life insurance plan.
So, quick question for you. If the market is performing poorly, what would that mean for your universal life insurance policy?
In most cases, there is a universal life, a form of it called indexed universal life, and that is more tied to market indexes. But traditional universal life, it's more of the insurance company guaranteeing a rate each year that they'll pay on a policy. Now, one of the downsides that happened in the 80s as interest rates began to go back down away from those 15, 16% rates, these policies, when they were first purchased, looked great, and a lot of the illustrations that were on the policies assumed that those rates would continue. Well, we all know, especially today when we're looking at a 10-year treasury that's less than 1%, that to get that kind of return on your savings is just not happening. So that really affected the performance of these policies.
So the rates are tied directly to whatever the interest rate is at the time? Is that how it works, or how is it redetermined every year?
So the insurance company actually makes that determination, and most of the time it's based on what they're earning, so what the insurance company is earning on their investments that dictates what they're going to pay you, but it's definitely declared by the insurance company.
Okay, so when you buy the policy, you don't necessarily know how it's going to perform.
That's exactly right. So what'll happen is your agent will run an illustration for you, and it'll be based on what amount of death benefit that you are looking for, as well as what amount of premiums that you're looking to put into it, or savings you're looking to put into it. Now, these policies have a couple of different components to them. So they have a death benefit component. Well, that's actually called a mortality charge. So that's what gets paid to protect you, if something happened, to pay for that life insurance side of it. Then they'll have administrative charges that are built in to the policy. Those are used to pay commissions to the agents. They're also used to pay the insurance company. And so when you run an illustration, all of these typically are disclosed. And then there will be the interest rate assumption based on what the insurance company is going to pay you. Now, there's normally a guaranteed assumption and then a current assumption. The guaranteed is going to be the worst case scenario, and the current will be based on how things look today.
So who would be the ideal person that this policy would probably be good for?
Yeah, we see a lot of people who use a version of this. It's called a guaranteed universal life. So it's similar to whole life in the sense that if you pay the premium, the policy will stay in force with that death benefit. So that's one area that we see people using these policies because they want to guarantee that they'll have a death benefit for 40 years, 50 years, or up to age 120. A lot of the policies will guarantee that. We do see some people purchase these policies for the savings component, although with the introduction of indexed universal life, the policies have not performed as well in most cases as an indexed universal life policy will perform, given if the market is going up. So, the indexed universal life has definitely taken the place of most universal life policies when it comes to saving in those policies.
What that really means is rather than the number that's decided on every year by the insurance company, in an indexed universal life, you're actually tying the growth on your policy to an index, so like the S&P 500, for example.
That's right, and we'll go in another video, we'll actually go into detail on those types of policies, but that's right. You're using an outside index, and depending on the insurance companies, there's all sorts of ones. There's the S&P, there's the Hang Seng, there are other indexes out there, the European index. So you can, kind of pick and choose which ones you want to take a look at. But remember, in those policies, you're not actually in the market. The insurance company is just using that index to pay you a certain rate of interest over a period of time. So hopefully this has give you a little bit of flavor. We're going to continue this series with looking at some of the other permanent products. We're Michael and Shannon with Healthcare Genius, and we're here to help in any way we can. Thank you.